Hey everybody, John King with Summit Funding coming to you live with my Financial Friday weekly series. So this series, every single week, I'm going to talk to you about a financial topic, many different things that we're going to cover. We've been doing these for about the last 9 months and continue to hopefully provide good value on things that have to do with mortgage, obviously, things that just have to do with money, things that have to do with estate planning and finances and taxes and all those fun things that we all love to talk about and think about and worry about. Today, we're going to do a mortgage segment and we're going to talk about jumbo loans and what is a jumbo loan. And I think that's a bit of a misleading topic because it's just that's kind of like a jumbo egg. I don't know about you, but it's like, well, okay, I see eggs and I see jumbo eggs, and why am I paying more for a jumbo egg? Because there's more stuff inside the egg. It's bigger. I don't know. Maybe it fries out to a bigger fried egg. I'm kidding. But the point is, jumbo clearly means larger, but what does it really mean? Like, what is a jumbo loan? And I think the better way to explain that is to start with what isn't a jumbo loan. So we're going to talk today, and I'm going to use the term agency loan. Now, agencies are departments or affiliated companies to the federal government. And so an agency is Fannie Mae, Freddie Mac. Technically, we can call it FHA, VA, USDA. Those are kind of the agency loans. Lots of terms we can throw around, but basically, those are loans that are sponsored or backed, insured, or guaranteed by the federal government. The problem is the federal government draws a line in the sand and says, we don't want to put too many eggs in one basket. By the way, do you see what I did there? I talked about jumbo eggs, and now I'm talking about too many eggs in one basket. That was pretty good, huh? I impressed myself. Anyway, by the way, feel free if you're watching live. There's about 10 of you watching live. I would love for you to comment on my puns and how amazing they are. So I'm happy to get some feedback on my puns. Anyway, the agency loans are backed by the federal government and historically have been the safest loans to do. So lenders forever would do agency loans, and they would be able to sell the loan to the federal government. It would be backed by the government, and the guidelines are very, very consistent. Jumbo loans are the opposite. Jumbo loans is every other type of a loan. We actually, the better term is what's called a non-conforming loan. So there's conventional, a lot of terms I'm going to throw out here, but there's a conventional loan, which is the Fannie Mae, Freddie Mac. But then technically you've got a conforming, which means it conforms to the agency's guidelines. And then you've got non-conforming, which means it doesn't conform to the agency guidelines. That typically has to do with loan size, meaning that it's over the limit for conventional loans. That limit comes out every single year. It came out about a month ago, and the limit for homes across the country are about $725,000 ballpark for everybody in the entire United States. And then anything above that is a jumbo loan, unless you're in what's called a high balance market. Now, a high balance market, for example, in the Sacramento, Yolo, El Dorado, and Placer County area is about $765,000. So you can go over 725 all the way up to 765 and still be a conventional conforming loan. You don't have to be jumbo. In the Bay Area, it's about $1 million. So you can buy a home in the San Francisco Bay Area and be up to $1 million and still not be a jumbo loan. You can do conforming loans up to that limit. Jumbo is typically anything above that limit. Now, I want to start with kind of a brief history of jumbo loans over the last 20 years so that you understand where they came from, so that you can better understand where they're going. So I'm going to pull up a couple of slides. We're going to start with from 2000 to 2006. That was the heyday of the mortgage world. We were doing anything and everything during that era, and we were providing loans for a lot more flexible guidelines. We were doing a lot of different loan programs, and those loans, actually, a lot of the loans that we did were non-conforming loans. What I mean by that is even somebody who bought a $300,000 home in 2004, they often got a non-agency, non-conforming loan because FHA, Fannie Mae, Freddie Mac, they weren't as progressive as a lot of these special programs. And so a lot of lenders said, well, wait a second, why would I want to sell to Fannie Mae and Freddie Mac when we've got private money that's going to have more relaxed guidelines and we're going to get paid better on these private loans? So the truth is, from 2000 to 2006, everything for the most part was non-conforming, regardless of loan size. So we were getting private money and we weren't using the federal government's money. So even though agency loans existed and jumbo loans existed, the truth is everything fit into that other category of non-conforming. So now we go to the next era, and that's going to be 2007 to 2011. And that market had a bigger shift. That market obviously is when the downturn happened with the mortgage world and the real estate world. We saw the crash and the non-conforming market collapsed. There used to be, from 2000 to 2006, there was actually a kind of, think of it like a flea market, like the stock market. There was a market that traded or sold non-conforming loans. And they could set a value and they would sell them to the stock market. They would sell it to mutual funds and bond markets, and people would trade non-conforming loans. In 2007, that disappeared. We've literally never had, the term we use is called the secondary market, or a market where you buy, sell, and trade loans. There is a secondary market for agency loans. Since 2007, there has not been a secondary market for non-conforming. Why is that important? It's actually critical in the understanding of where jumbo loans are today, because everybody had to start lending their own money. When there's a market to trade, sell, and buy loans into, the rules are fairly homogenized so that that market drives what the rules have to be. When everybody is buying and selling into the same market, the market self-governs and sets guidelines that say, hey, we're not really having an appetite in this market for loans that are below a certain credit score or above a certain debt to income ratio. But in 2007, that market went away and it has never come back. So what happened is big banks stepped in with their own money. They saw a void in the market, which, by the way, there's a void that was announced earlier this week that I'm going to tell you in a couple minutes that's going to make a really big impact to jumbo loans. But the banks saw a void in the market and they stepped in. They said, hey, we've got deposits sitting right here that we want to loan out. And I don't know what else to do with them that makes more money and has good security. It's kind of crazy. You're going to say, John, how was it good security during the market crash? Because loans that had a problem were the loans that were done prior to 07. The loans done in 07 to 2011 were super secure because they were documenting everything. The deal, though, is that rates were higher on jumbo loans than conventional loans. So these banks stepped in and said, I'll do it, but I want to get paid for it. So you've got to pay me more in income, more in interest than what we're getting on a conventional loan. So that's kind of what happened between 07 and 2011. So now we move forward to 2012 to 2019. And what we see in 2012 to 2019 is the agency loans, specifically Fannie Mae and Freddie Mac, added what's called a guarantee fee. Now, the term we use in the industry is G fees. It was enacted by Congress as part of the TARP bailouts. And guarantee fees are nothing more than a tax. And it is a tax applied to all mortgages going forward to protect the federal government, because the government had to bail out Fannie Mae and Freddie Mac previously, and now they want to make sure that doesn't happen again. And so they're going to charge this tax. Remember, at this point, Fannie Mae and Freddie Mac were under conservatorship. They were being overseen by the federal government. As a matter of fact, Fannie and Freddie are still under conservatorship. What that means is all of their profits were siphoned off into the coffers of the federal government. So the government's making all the profit on the conventional loans, and they're getting to charge these extra taxes. What that meant is that jumbo loans started to become less expensive than the conventional Fannie Mae, Freddie Mac loans. And the reason they became less expensive is because that tax, Fannie Mae and Freddie Mac, kept increasing the amount they were charging in guarantee fees. We also had some non-banks join the jumbo world. We had insurance agencies, insurance funds, AEG, AIG, American Insurance Group, AIG became one of the larger jumbo loan financiers. Why? Because they were trying to find places to put their insurance money that was going to earn good returns so that they would have that money available to pay out claims. We also had real estate investment trusts that jumped in and said, hey, we've got money, we're going to invest these in jumbo loans. But it was still a market dominated by depository banks and their partners. So during that era, companies like Summit Funding, we would partner with a big bank, we would partner with a mid-sized bank, and we partner with some of these non-bank companies like real estate investment trusts and insurance companies. And we would offer a multitude of jumbo loan products from each of those different avenues. So it gave a lot of flexibility. It gave a lot of options when you went to an independent mortgage bank to get a jumbo loan. But the truth is you were almost always going to get your best deal if you were the most well qualified by going directly to the big banks, because the big banks were using that as a way to bring on wealthy clients. Think about this for a minute. If you are buying a home and you are buying a multi-million-dollar home, it's likely that you're going to have money to invest and to put in the bank. So the large banks are going to say, hey, I'm willing to not make money on that jumbo loan because I know I'm going to get my teeth into that client and get him to be willing to do other business with me. So they were using it as kind of a loss leader to buy business, but they were making sure it was only for the cream of the crop. So their guidelines were super restrictive and would prevent the average person from qualifying. The guidelines had gotten so tough that basically for some jumbo loans, you had to have what's called 20% PCL or post-closing liquidity. So you buy a house for $2 million and you put $500,000 down, and so you've got $1.5 million of a loan amount. They wanted to see 20% of that $1.5 million or $300,000 in the bank, not in investments, not in your retirement 401k, but literally cash ready in the bank to make sure that if something happened in a downturn, you'd have enough money to pay back your monthly payments and keep current. So the restrictions, the guidelines were super strict from the big banks, but they offered the best interest rates. Everybody else had to find another avenue that wasn't as restrictive. And that's where independent mortgage banks like Summit Funding came in, because we're not loaning our own money. We're loaning money from the multitude of banks that we work with. And so it created a lot more flexibility until 2020. So in 2020, COVID hit. And we literally had 3 months of no jumbo loans. The market shut down. From March until June, there was nobody doing jumbo loans. The banks were pulling back and afraid of what was happening in COVID, where the economy was going. Are people going to be able to make their mortgage payment or not? What's going to happen? And so they shut it down because there was no secondary market. Because it's called liquidity. There's no liquidity. There's no money flowing in and out. Everybody's loaning their own money, and banks went into protection mode. And so it created an environment that exists still today where there is uncertainty about where funding and financing is going to come from for jumbo loans, because if a bank changes their mind, that funding can dry up in an instant, as I'm about to explain. So they did come back in June of 2020, but with some pretty significant limitations, more post-close liquidity required. The 5% down payment jumbo loan was gone. You were looking at 10, 15, 20% minimum required down payment. And those are still some of the challenges that we're dealing with today. So now we fast forward to 2021 and 2022. Jumbo loans are still commonly cheaper than agency loans. Okay, so you actually were better off buying a bigger house and getting a jumbo loan than you were buying a smaller house and getting a Fannie Mae conventional loan. And that has to do with the guarantee fees. It has to do with the fact that banks were being pretty competitive on the jumbo loans, trying to find ways to invest their money. But the guidelines continued to tighten. We continue to see debt to income ratios being restricted on the best interest rate loans. We continue to see bigger down payments being required on the best interest rate loans. And even on the high interest rate loans, the minimum down payment kept getting tighter. The 5% down payment, as I said, had gone away, and we're looking more at 10, sometimes 15 or 20% down to get the best terms. And what we have now in 2023, I'm recording this 13 days into 2023, and there is significant implications that have already happened in 2023 for jumbo loans. Wells Fargo announced 3 days ago on Tuesday, so I'm recording this Friday the 13th, and on Tuesday the 9th, I think, 10th, that Wells Fargo announced that they are pulling out of a lot of mortgage segments. They're scaling back. Wells Fargo, since 2010, had been the largest mortgage lender in the nation, pretty much until probably 2018 or 2019, when Rocket Mortgage started taking over, and then United Wholesale Mortgage started taking over. Wells Fargo is currently number 3 in the size of mortgage lenders in the country. But Wells Fargo announced the other day, hey, we're pulling out. We're only doing mortgages where we are working with our clients. We're not going to partner with banks. We're not going to offer jumbo loans through other banks. We're not going to do, we're going to sell a lot of our servicing. So people who make their payment to Wells Fargo is selling that servicing. They don't even want to participate in mortgage anymore. It's going to have significant consequences because Wells Fargo was pretty close to the largest buyer of jumbo loans. They had between 30 and 35% of the market. So 1 out of every $3 of jumbo financing flowed through Wells Fargo. Remember, there's still no secondary market. There's still no place for mortgage companies to buy, sell, and trade jumbo loans. So we have to go straight to the source. And one of our biggest sources just went away. And it is going to create some turmoil. Now, there's some opportunity. I think there's some banks talking about wanting to step in. I was in a meeting this morning, and we're hearing from our people that manage the relationships with these banks, and they said, hey, we got a lot of banks who are stepping in that want to fill in the gap with Wells Fargo, but nobody's willing to be the first one because Wells Fargo had interest rates significantly lower than everybody else. And so we are in a position where there's a void, and we're going to have to see where that void takes us. So I want to transition. Now, remember, if you're watching live, please post any comments you want about whether you agree with something I'm saying, disagree, or have a question. There'll be time throughout the whole thing where I'll pause and ask questions. So I've got about 5 or 6 people watching live right now. If you're not watching live, no problem. Just post comments on whatever platform you're seeing the replay, and I'll jump in and reply and help guide you. So let's talk about what makes jumbo loans different. How are they viewed different than traditional loans, and what things do you need to be worried about as you're going about getting a jumbo loan? So there's 3 things that we care about in the mortgage world: cash, credit, and income. And so I'm going to break down those 3 areas and help you understand. And actually, the 4th thing we care about is collateral, or the property. And because I didn't have a slide for the collateral, I'm going to talk about collateral right now and get rid of the slide that's up there. So jumbo loans actually care about the collateral different than conventional loans. Many jumbo loans will require 2 appraisals on the property, and they'll take the lower of the 2 values. They want to make sure that they are not overextending themselves by loaning it on a house that isn't worth as much as what the purchase contract is. So even if there are some banks that will still do 1 appraisal, they still want an appraisal review done by another appraiser to review that first appraisal. So we have greater restrictions on the number of appraisals. And remember, they're going to take the lower of the 2 opinions of value. So it can create greater challenges with the jumbo loan. Another thing is that the jumbo loan is market specific, that a lot of jumbo lenders are saying, look, we're going to loan a lot lower percentage of the home value in certain high risk markets. So Fannie Mae, Freddie Mac, they don't say that. They loan the same across the country. Jumbo lenders say, you know what? I'm worried about prices in Arizona dropping because they rose so quickly. So we're not going to go over 70% loan to value, meaning that you have to have at least 30% down. Now, that's not an exact rule. That's a theory of how jumbo loans look at things differently. And the final thing about the collateral of the property that's different with jumbo loans is that a lot of regular agency loans, I can do a holdback to have work done afterwards if there's problems. You can't do that on a jumbo loan. So the work has to be done before the property is sold. And so you have some challenges there that you're going to deal with when it comes to collateral. Now let's dive back in and talk about the cash assets. So we'll talk about cash, credit, and income. And let's talk about what is different on jumbo loans compared to conventional conforming loans. So first of all, larger down payments. If you do even a high balance conventional loan, you can put as little as 3% down or 3.5% down on an FHA, or 5% down if you're not a first-time home buyer. But that doesn't exist for jumbo loans. You're looking right now at least a 10% down payment for a jumbo loan. You're also going to need a significant amount of reserves. Now, I want to be really clear here. I think reserves are critical to anyone purchasing a home, because reserves, in my opinion, are the single biggest difference between succeeding and failing in home ownership, because things come up that we don't expect. Maybe it's an issue like COVID where you lost a job. Maybe it's an issue like a recession that may be coming up where you lose a job or you have to get another job that doesn't pay as much. Maybe it's an issue with the weather that we're dealing with and that you had some storm-related issues or a leak or the roof needs to be repaired or replaced. Those are things that happen with home ownership. Now, don't misunderstand. The benefits far outweigh the challenges. You're going to make more wealth over your lifetime through the equity of your home than almost anything else in most circumstances for most people. So it's a good thing to own a home, but it does cost money. Okay. Just a quick reminder, the biggest benefit of owning a home is that your payment will stay the same or go down because you can refinance later, even though your income keeps going up. So people are worried about, gosh, John, payments are super high. Nobody can afford the interest rate and the payment today. But if you can, you're locking in that payment instead of having rents that are going to keep going up. Your pay is going to go up too, but your rent's going to go right up with your pay. When you own a home, your pay goes up because of inflation. You normally have raises and cost of living adjustments. Your mortgage payment stays the same, so it's a smaller percentage of your income. And you have the ability to refinance to lower your monthly payment down the road. So home ownership is great wealth building long-term. It saves you a lot of money long-term. Short-term, if you don't have the money in the bank to cover a roof leak, you're in trouble. So that's the challenge with assets, that I think everybody buying a home ideally should have assets left over as reserves, as rainy day fund. It's pouring rain, as a rainy day fund. But if the only way you can buy a home is to use up all your assets, then your first focus after buying the home is to rebuild that savings account, rebuild your assets. So I know I'm getting on a soapbox here. I'll jump off my soapbox in a second. Assets are critical, but on jumbo loans, they're mandatory. On conventional FHA, we don't care. We don't care if you don't, in most cases, we don't care if you have 2 pennies left over to rub together. Jumbo loans say, no. Not only do you have to have 2 pennies, you've got to have 6 months of mortgage payments left over. You have to have 24 months of mortgage payments left over. And don't get me started if you own other property, because they're going to want even more reserves left over. And they exclude some of those reserves from the calculation. Remember, they're loaning their own money. These banks are loaning money out of their vault. They get to decide what they want to allow. And so if you've got somebody that says, hey, I'm loaning you $1 million, but I want to make sure that you have at least $100,000 in the bank. And if you don't, I won't loan you the money. Guess what? They hold the money. They're the ones that get to decide. And they can say, oh, by the way, that money you have in retirement, that doesn't count. That money that you just got, 2 months ago, that doesn't count. There's lots of little nuances. So just be aware, it is a more invasive review of your assets, and there's some assets that are not going to allow us to count. So it's critical to understand the difference if you're purchasing a home using jumbo financing. All right, so let's talk about income. So from an income perspective, the difference is, first of all, stricter view on documentation. If you are self-employed, be ready for a challenging process if you're doing a jumbo loan, especially when you want to get the best interest rates. Remember, there's multiple banks that run the gamut of guidelines and their flexibility versus interest rates. And you're never going to find the most flexible guidelines at the lowest interest rate. You're going to find the most flexible guidelines at the highest rates. You're going to find the lowest rate with the most strict guidelines. So it's critical to understand that if you're self-employed, we're going to clearly need 2 years of your tax returns. We're going to need a profit and loss and a balance sheet for your year-to-date. And in this case, we're starting a brand new year. So it would be for 2022 and year-to-date 2023 that we would need that. And there's a lot more digging that is done on a jumbo loan. So that's the first thing. The second thing about income is they restrict your debt to income ratio, or how much of your income you can spend towards your bills. The maximum most jumbo loans will go is 43%, versus the agency loans can go as high as 50 or 55%. Now, somebody might say, John, you're on crack. Why would somebody want to spend 50 or 55% of their gross income? Well, the truth is, there's often times when that isn't a real representation of your income. There's often times when you have more income, but we can't count it for one reason or another. Maybe you have somebody who's been living with you that will be renting a room, and you're confident they will be. Maybe you have a spouse or significant other that doesn't have good credit, and so they can't be on the loan, but they have income, and so you can afford the higher payment, but you just need to be able to stretch how much of your income you can use, because there's other income that I'm not considering. So just be aware that there's room to stretch on the conventional loans. There's not room to stretch on the jumbo loans. They're very, very strict when it comes to debt to income ratio. All right, now let's talk about credits. So from a credit perspective, the biggest thing is credit score. So an FHA loan, if FHA and VA, I can go as low as a 580 credit score. For a conventional conforming Fannie Mae and Freddie Mac loan, I can go as low as 620. But for a jumbo loan, when we're exceeding those limits, we're looking at minimum of 680, and oftentimes the minimum is as high as 720. And so there are restrictions that somebody could qualify for a mortgage if they were doing a conforming loan that they can't qualify when they do jumbo. And they also have more strict rules when it comes to how many accounts have you had open in the last 12 months, and what is the history with those accounts. So for example, you have to have had, in some cases, 3 accounts with at least a 24-month history, and at least 2 more accounts with at least a 12-month history, all rating within the last 12 months. So that gets a little bit confusing, but the bottom line is they don't want somebody that has a 780 credit score because they opened up one credit card 6 months ago and they paid it on time. So they're looking not just superficially, because conventional loans look somewhat superficially. As long as your score is good enough and there's nothing negative, we're fine. Jumbo loans are digging deeper. They're looking more at traits that are going to give them an idea of, hey, is this really going to perform? Are they really going to pay? Is their credit score really representative of them paying a multitude of bills over time? So just realize with jumbo loans, you've got to have deeper credit for a longer period of time or a longer history with those accounts. All right, so I've got a couple of questions left that I'm going to talk about, and I'm about to wrap up. If you have, I got about 7 or 8 people on here right now. So if you have any questions that you want to make sure I answer, please post them into comments now. I'll be able to see your comments and reply to them. If you have any suggestions, thoughts, tips that you've heard in the past, I'd love to hear that as well. But let's talk about a couple of facts. First of all, should I go to a big bank directly? The truth is, yeah. If you're doing a jumbo loan right now, I think you start with a big bank before you talk to me. Let me rephrase that. We talk at the same time. So call me and call a big bank. 9 times out of 10, a big bank is going to have better terms than I am. That's the truth right now. But their guidelines are going to be super strict. And so you call me and I say, hey, it looks like I can do this. This is what the numbers look like. You call the big bank and the big bank says, yeah, I can do that. And this is what the numbers look like. And now we can compare. Because I don't want to disappoint you by you finding out later that you could have gotten a significantly better deal by going to your bank. But the truth is the box is super small. And with Wells Fargo exiting, I think the box is getting smaller. And so what you're going to find is if those banks don't give you what you have to offer, I'm going to be your best option, because I have 7 different finance institutions that I get money from that have a range of guidelines. I have a toolbox of different programs for jumbo loans. Each bank only has one tool. And guess what? If the only tool you have is a hammer, everything looks like a nail. So they're going to try and squeeze you through their box and then find out that they can't qualify you, that you don't meet their guidelines, and it's going to create a frustrating experience. I'm not telling you that it's not going to be frustrating working with me because, first of all, let me be clear. I'm not saying I'm going to make it frustrating. The mortgage process is built to frustrate. I hate to say it. Since 2008, we were blamed for collapsing the global economy back then. The entire weight of the federal government came upon us, and it is a frustrating experience no matter what. But it's going to be worse trying to squeeze a square peg through a round hole with a big bank if you're not their perfect clients. So yeah, I think you should go to the big bank and talk to them and talk to me and figure out which is the best option for you. All right, the last thing I want to talk about is kind of what does the future of jumbo look like? Here's the deal. Well, Wells Fargo, if you're just catching up right now, Wells Fargo announced 3 days ago they're pulling out of correspondent lending. That means that they're not letting other banks like Summit Funding tap into their money. They are selling a lot of their servicing. They're scaling back mortgage operations. They don't want to be a big player in mortgage. This is literally what Bank of America and Chase did back in 2008, 9, and 10, and they scaled way back. They were two of the largest banks running neck and neck with Wells Fargo. They scaled way back, and Wells Fargo stayed aggressive. Wells Fargo's made the decision this week. They are scaling way back. So Wells Fargo being the biggest buyer of loans from private mortgage banks like Summit Funding, it's going to create a void in the marketplace. The question becomes, where are we going to go in the short term and where we're going to go in the long term? Last week, I did a video about where I think the housing market is going, where interest rates are going. So if you didn't see that, you need to check it out. It's about 40 minutes, and I think it's really, really powerful information. So I'm not going to repeat that. What I'm going to talk about is the economy is going to drive jumbo financing. What do I mean? I mean, if we think back to 2020, when the economy had a major issue with COVID, jumbo loans pulled out and they said, we're done. We're not, every bank stopped doing jumbo loans pretty much during that 3-month time frame. We are on the precipice of a recession. The Federal Reserve didn't catch inflation early enough. Now the Federal Reserve has raised interest rates so much that there's no alternative but for us to go into a recession. And banks are going to be pulling back and more conservative in a recession because their concern is, hey, I don't want the business owner that I just loaned $2 million to go under, and I'm stuck holding the bag with that $2 million home. So I think guidelines are going to get tighter. I think Wells Fargo isn't the only bank that's going to make the decision of pulling back in the mortgage space. And because there's no secondary market for jumbo loans, we're going to be hard pressed to find banks that are willing to loan their money. There is a term in the mortgage industry called adverse selection. Adverse selection means I was picked for a negative reason. I was picked because I'm the only one left doing something. A great example was FHA credit scores down to a 500 FICO score. FHA will offer down to a 500 FICO score. And years ago, everybody did it. And then some banks started pulling back and other banks started pulling back. And finally, you only had 3 or 4 mortgage companies that would do it. Well, the problem is that every lender, every realtor would send their clients to that bank for their low FICO FHA loans, and a larger percentage of their book of business was low credit score FHA loans. They were being selected as the lender of choice for an adverse or negative reason. And so as people start pulling out of a segment, the people who are staying there start wondering, what does that guy know that I don't know? Even if if there's nothing that he knows that I don't know, I'm one of the last ones left doing this, which means I'm going to get a disproportionate number of those types of loans. And if that market has problems, I'm going down. Let me give you a different example of how that works. It's like insurance companies in the state of California. There's a lot of insurance companies who have suffered pretty sizable losses because of the wildfires, and they refuse to issue new insurance in the state of California. They also go pocket by pocket geographically and say, you know what? We have too many homes in this segment, in this wildfire zone that we've already insured. We're not going to insure anymore. Not because they're unwilling to provide insurance in the state, but because they don't want to have all of the insurance policies in a particular neighborhood in case that neighborhood burned down. because then they would have an adverse or negative impact from that particular event. So the mortgage companies think the same way. They start wondering, man, if somebody's pulling out of here, maybe I should consider pulling out of there. So we're at a time where the future of jumbo loans, no, I don't think they're going away. No, I'm not trying to paint doom and gloom. But what I am telling you is we've had a run for the last 12, 14 years where jumbo loans were cheaper than conventional loans. I'm curious if that run's come to an end. I'm wondering if we're going to end up seeing jumbo loans getting more expensive again because the banks that remain doing them are going to price that risk into what they're charging. That's the biggest concern I have going forward. So I hope this has been valuable. For those of you who are still on here, I've got some time right now for questions. So if you have any, please feel free to post them. If you have any parting comments, if you like my shirts, I don't care. But anyway, no need to comment if you don't have anything to say. I'm just filling in some time in case somebody's typing to give them enough time to finish typing so that I can bring up their comment and address it. Otherwise, I really appreciate you. Next Friday, I'm going to be teaching how to qualify for a jumbo loan. Not really, just kidding. I'm going to be talking about how to build up $1 million in cash net worth. It sounds like a daunting number, but the truth is there's some techniques that you can use that can have the average person be a millionaire. And I'm going to teach you some of those things. It's really about money management. It's about understanding interest. It's about a lot of different things. But the fact is, My Financial Friday is designed to help you be a better financial steward of your money and better in investing, better in buying of homes and navigating your money and navigating your financial needs. So next Friday, join me on the 20th at noon. I'll be doing the same time, talking about a topic of how to build up $1 million in net worth. So appreciate everybody. Thank you for listening. Hope you have a wonderful weekend. Try and stay dry. We'll talk to y'all soon.